Hello, everybody. My name is João Mischiati. I am from Brazil, but I operate in the United States for a while now, and I'm having great results. So I'm here to share what strategies you can do so to make more money. This one is going to be very basic, but as as if I get more views in this YouTube, I don't know how it goes. I can show more possibilities, so you can also make more money than just sell covered calls or just sell puts or do a strangle 45 days and buy 15 days after. That that things that really doesn't work. Even if you do a back test, is I don't really trust in back tests. I mean, it's real, but the future is uncertain. And if you do back tests, you don't know what's going to happen. Especially if you really want to do a serious test, you should do a Monte Carlo and see the actual risk you're taking and check your probability. Or you can do some different trades that you exactly know how it goes and what and if it goes this way you can do some type of hedges, especially here in the United States. It's easier. Okay, we have a lot of liquidity, so we can use this for making more money. Yeah, and of course if you have margin you never pay anything. Okay, it's unbelievable. If you have margin, you're okay. You can do some hedges after. And the problem is that I don't have a really great margin here in the United States. I operate also in Brazil, doing good, not as good as the United States, but I'm getting a nice rentability. Okay, so today it's going to be a simple difference of um, you can do with covered calls versus vertical booster. Okay, I don't know how it calls in the United States, but I mean that's I'm going to explain, and that's what we can do to make a little bit more money. Not as great, but better than many strategies. And I also can teach you other strategies. Let's go. Okay. So, cover call versus vertical booster. So, we have to navigate on income and risk in options trade. Risk is the basics, okay? So you have understanding the core mechanism of each strategy. Okay, analyze risks versus reward. If you really know covered calls, you can forward, and then I explain the vertical booster. Identify suitable market condition, and of course, making informed strategy decisions. Okay, so let's go. Strategy one: covered call, the basics definition. Okay, covered call strategy involving selling a call. Okay, I will show you the example. The option is 100 share stocks that you already own the covered part. So basically, it's generating income premium on your stock you hold. Okay, especially in neutral or slightly bullish. Depends, of course, what kind of stock you have. If you have stock that's high volatility, it's not just slightly bullish, can be really bullish. How it works step by step. You own every 100 shares of stock you have, you sell one call option. Usually they say OTM or ATM, short term expiration. And then you collect the premium. Okay, easy. The maximum profit is limit, premium received plus strike price minus strike purchase. Okay. Maximum loss is the share you hold. Okay, if it really goes down, and minus the premium collected. So it's better if it goes zero is better and to sell at least a cover call then that you didn't do anything. Okay. Break even point strike minus premium receive. Now I'm going to tell you what is the vertical booster, and then we're going to compare in a practical exercise so you can see which one is better. I prefer much more the vertical booster. Definition, okay, a vertical booster involves simultaneously buying and selling two options of the same time. Calls on the same underlying as you sell two calls, okay, at the same expiration date, but different strike price. Okay, how it works. If you own 100 shares of stock, you buy one call option, usually ITM or ATM, short-term expiration. Example, $50. And then you sell two calls options at the higher price. Example, $55 for the same expiration. Okay, for the same expiration date. That's the normal vertical booster. Maximum profit, of course, is limited to strike price plus the difference call sold minus the call purchase. Okay, here you can make more money. You can lose, you don't receive premium, but you can make more money if the stock goes up. Maximum loss price times 100 shares can lose up to the entire stock value. That's the maximum you can lose. Okay, you still, it's better if you have stock at least you and you want to sell higher. Vertical booster is the best option. Okay, especially when went down like 5, 6, 7% your stock, you can do that. So you can recover 7, 8% doing the vertical booster. Okay, vertical example. Okay, Tesla. Tesla is high volatility. Okay, was $32. And then I sold a call for $140. Today, that I'm recording December 7th, it's for 153. Yeah, so I would make profit. I received this premium, $25. Nice, almost 6% premium. Great, great. And my maximum profit is $33. It's 25 plus the difference here, $8. Okay, so I can make up 7.75%, and the break even is $406.50. So I have a great break even. It can go down a little bit. Okay, I won't lose money. And it's like I sell the stock for $465. The call plus the premium. Nice. Okay, I'm not getting rich by doing covered call, but it's good. If you want to buy a stock, you think that it will really go up. Okay, Tesla for $32. So now I bought this call, one call of the strike price of $395, and I paid $50. So I don't want to pay $50 for this. I wanna get this for free. Okay, I wanna get this for free. So I sold two calls for $104, and it gave me 25.50 and gave me $51. So now I have in stock one call, 200 here, and two call selling. So if it really, really goes up, I'm not in naked call, okay? Pay attention. I have in stock and one call, so I can sell two calls, okay? Premium almost nothing, okay? Maximum profit. If it goes up, really goes up, okay? I can make the difference. It just goes up of $8, it goes up for $440 or more. It's not hard, okay? $8, 2%, less than 2%, 1.5%. For Tesla is nothing. As I'm recording here, it's for 155, I guess. I can make 12.43%. I can make $8 here, stock that I bought for 132 and sell a call, so I make $8 plus $45 of this that I bought one call and I sold another call, okay, plus $45. So I can make $53.70. Can make 12.43%. My break even is $412.82. Okay, the other one was $406, and I could sell in 485 cents. Just if it goes up 440, okay, that's my maximum profit. But it's like I sell $485 and make 12% in 33 days. Why my break even is here? If for example, Tesla goes 420, I still can make I still can sell this cow for $25. Yeah, 420 minus 395 can sell for $25, because if the Tesla is up $395, I will make money with this cow. Okay, $5, $6, $10, I don't know. Depends the price. If Tesla is $400, I can sell this cow for $5 because I bought it. So let's compare. See, here is covered cow versus vertical booster. You see the probability of profit is bigger here, 64%. Here, 60%. It's less. I can lose more money by the stocks, okay, if it really goes down. But I can make more money. I can make 5,411. Here is just 3,411. Break even is great, 412. Here's for $405. But uh, really has to go really down to make this loss. It has to go less than $395 to make more loss, much more loss than here. Because still I have discount that always can get me something. Okay. Here's an example how much I would lose. Okay. Stock really goes down, $350. I would lose in the cover cost $56.50. Not that much. But here I would lose more, $82.70. On $400, I lose $6.50, and here I lose $20 more, $26.30 per share. But stays the same, $420. Here I make $13.50. Same no, $12 less than the 432. Yeah, so it has to go 3% down. Here I start getting more money, $13.70. Stay close to the strike, $430. I make $23.50, and here I lose $33.70. Just $8 higher. I know, just $2 less. I make $10 more on this strategy. So probably it will stay the same. Most of the time, stay going up or going a little bit down. $12 down, I would make more money here. And of course, it goes 2%, less than 2% more. Okay, 440 or more, doesn't matter. Here I make $33, it's great, but here I will make $53.07. It's almost twice more than I can make here. It's $20. It's like 70 or 80% more I can make on this stretch. So it's just go 2% more, 1.8% more, you make 70 or 80% more in this vertical booster. I prefer, especially if I believe that the stock goes a little bit up or stay slightly the same. Okay, if it really goes down, the covered calls protect you more, of course, because you get the premium. The premium is a small hedge. Okay, and the other no, the other I I make more money with the call ITM that I bought. I bought a call ITM for $395, so it has to stay above this price so I can make more money. Okay, thank you for watching. I can give you many examples, many strategies that can make you like 40 or 50% more profitable with the same risk, or I can give you some strategy that's a little bit more risk, but can makes that has chance to make more money. I'm not showing you, I can show you like a 4 months covered call or something simple, strategies, but I prefer to stay more sophisticated and trying to find some opportunities. The opportunities will be on the long, long calls or the long puts. I will show you how you can make really, really money on the long term or in the middle term. There'll be 6 months or more. Okay. Thank you. Thank you for watching and have good investments.